Hello, everybody. My name is Jack Fig. I'm the Community Director here at Decarb Connect, and it's my pleasure to introduce you today to our January webinar in partnership with ClimeCo. So in today's discussion, our team from ClimeCo and a special guest from SBTi will be discussing the industrial approaches to insetting, offsetting, and emissions removal, and discussing the latest updates under consideration in version 2 of SBTi's corporate net zero standard. Now, before we dive into that, there's just a little bit of housekeeping from me before I pass over. Please feel free to share any questions you have in the Q&A box below, and let us know if you'd like to direct your question to anyone in particular. Our speakers will be answering your questions in the later part of today's session. Please just say who you are in your email when asking a question. And now I'd like to introduce our first speaker today, David Prieto, VP of Sustainability, Policy and Advisory at ClimeCo. Over to you, David.
Thank you, Jack, and thank you everyone for making the time to join us today. We're excited to co-host this panel alongside Kyra Powers and my colleague Kayla Carey as we touch on carbon management strategies in the industrial space. As we get started, a couple housekeeping items. The goal of this presentation is to update all of you on the changes that the Science Based Targets Initiative has been undergoing and considering as part of their public consultation process about the corporate net zero standard version 2 guidance. And we'll have a handful of case studies from ClimeCo's experience to touch on what we've seen in the market as it relates to these changes that are being proposed. If we can go into the next slide, we'll go through a round of introductions. I'm the head of the Decarbonization Advisory Practice at ClimeCo. ClimeCo is a global decarbonization firm that invests, develops, trades emission reductions across the world. As part of my team, Kayla is on this team, and then we're really thrilled to have Kyra join us as part of the Science Based Targets Initiative. Kyra, would you like to make an introduction?
Sure. Hi, thank you, David, and thank you to the Decarb Connect team as well as the ClimeCo team for inviting me here today. My name is Kyra Power. I am an engagement manager covering the North America region at the Science Based Targets Initiative, or SBTi. In my role, I do a lot of things, wear a lot of hats, but a huge part of my role is educating the market on upcoming standards development. So the corporate net zero version 2, what our proposals are, and then how stakeholders can best feed back into that process and get involved in shaping the future of SBTi standards. So thank you so much for inviting me here today, and I'm looking forward to the webinar.
Thank you, Kyra. And at the end of this presentation, we'll try to make some time for some Q&A, which Kayla will moderate. And if we don't get to time to some of the questions you all might share during this presentation, we'll try to make sure that we answer them after this hour together. So moving forward, we'll start with a brief introduction on the journey that SBTi has had as it relates to this corporate net zero standard. So the science-based target started in 2015 at the outset of the Paris Agreement to help garner support for private sector impact as it relates to the Paris Agreement. A key milestone since 2015 was in 2021 when the SBTi issued the first corporate net zero standard, which is what we call version 1, and it marked the first time there was guidance on helping companies to establish long-term targets for decarbonization. And now we're at 2026. It's been more than 10 years since that first founding of the Science-Based Targets Initiative, and the industry has learned a lot over those past 10 years. A big congratulations to Kyra and SBTi team, as I believe they made more than 10,000 validated targets recently. But version 2 of the corporate net zero standard, the public consultation started in March of last year. The second round of public consultations was commenced in November, and we're at the final stages of what is the first significant overhaul of the corporate net zero guidance. Kyra, is there any additional context that you'd like to share with the audience?
Sure. Thanks, David. I think just one of the things that, folks kind of love to ask about the behind the scenes process. How are these standards developed? How is stakeholder feedback incorporated? How many people respond to these consultations. So one thing that I do want to share with you is that we received about 950 responses to the first public consultation. We generally expect to see about 40 to 50% of responses in a second public consultation. But with this standard, because of how critical it is for guiding the future of corporate climate action, we actually saw over 1,100 responses to the second public consultation. So obviously our team has been really busy going through all of that feedback, analyzing, hopefully some of your feedback. But we are just so grateful and impressed by the dedication, the response rate, and the time that our stakeholders have taken to really digest the proposals and give us a lot of their thoughts and their expertise and experience back. So we're definitely busy, and we're really grateful to just have such a robust stakeholder engagement process.
Yeah, Kyra, a big shout out to all of you who've submitted responses during the public consultation. ClimeCo has done that as well, and our hope during this hour together that we also articulate the sort of examples of how a perhaps more pragmatic standard really opens the door for additional signatories to the initiative and help continue to drive decarbonization across the globe. And I think one of the shared missions we all have is in the next slide, this remarkable growth of target setting and validated targets the SBTi has achieved, and how with the perhaps revised standard, we can continue that trajectory to continue to increase the market for companies who are undergoing that energy transition and creating value as it relates to low carbon products and managing the risks associated to the impacts of climate change. Kyra would like to speak a bit towards the business case of why you've had so much success getting the private sector involved, and what are the plans of continuing to do that with this version
Sure.
2?
Yeah, and I think so. If you haven't seen it, we put out kind of a reflection and a piece on the business case and the business benefits for setting science-based targets. And we deployed a survey to various sustainability practitioners and leaders in the corporate space. And here's what we saw. We saw a lot of overall positive impacts from setting science-based targets. Some of the things, I come from a corporate background, and some of the things I personally witnessed in a corporate setting was just that alignment piece, right? So when you have a science-based target, you're really able to align your internal stakeholders towards a common goal. You're able to set kind of that North Star, that best practice for what decarbonization looks like, unique to your operations and your supply chain. Other things that we have seen, and I'm not sure, I don't think it's listed here, but innovation, we're seeing that come across. Companies that have science-based targets, there's an incentive to innovate in terms of the products you offer, the services you offer. And we're seeing that as kind of a competitive edge for these companies that are taking on strategies to decarbonize. As you can see here, investor confidence, we get a lot of investors who are calling, contacting the SBTi to understand, they're seeing climate risk as a real risk to their returns, to their portfolio. So we're seeing companies that take on science-based target setting, who have an active strategy to decarbonize. We're seeing them really have more favorable terms with investors. And then beyond that, I think there's that reputational piece, right? I think consumers are increasingly aware of what companies are doing, and companies who set science-based targets have a commitment to climate action. We'll hopefully see that in terms of their consumer base expanding.
Thanks, Kyra. And I think one of the key values SBTi had when it was founded was setting the stage of what is a reputable target when it comes to decarbonization, and helping companies, investors, and other stakeholders be able to compare apples to apples. In our experience at ClimeCo, one of the things that we've learned is perhaps one of the limitations of version 1 was it helped companies establish a commitment and what a trajectory to net zero might mean. But then what happened once you establish that target? How do you continue to ascertain performance? And we believe the past year and a half of public consultation is going to really outline what this iterative process looks like on the journey to 2050 for most companies. So we're going from a world and a standard that help guide what establishing a target is, to then establishing now how do you manage that journey towards that target, which is very exciting. On our end at ClimeCo, We also see a lot of other financial and operational benefits that relates to the journey to net zero. There's an increasing amount of initiatives that are trying to demand or aggregate demand for low carbon materials, fuels, and electricity to help reduce the risk and accelerate the go-to-market strategies of these low carbon alternatives. Right now, in the electricity market space, we already know that the majority of global demand can already be supplied by new clean energy sources. We see an increase in market share of electrified transportation. And now, with the proposed changes that we will touch on later in this agenda, we might see similar accelerations when it comes to demand for low carbon materials. And these are just some examples from the IEA of commitments for low carbon steel and cement. And the version 2 guidance, with the asterisk that it still has to be finalized, might accelerate and provide these demand signals to help an audience like all of you to really have a more established demand for those equally performing but perhaps lower carbon alternatives that you're developing. All right, so on to the next section. So we're going to now dive deeper into the actual draft of the version 2 of the guidance. In the next slide, high level, what we outlined before was the version 2 is going now to an evergreen process compared to version 1. So it's going to be iterative for companies who have a science-based target to really understand and articulate to the SBTi what are the ongoing needs and progress metrics to that journey to net zero. Some key things to have in mind is there is now specific differentiated requirements for Scope 1, Scope 2, and Scope 3, as well as the now option to have a reputational requirement for ongoing emissions. But Kyra, is there anything within this summary you would like to highlight to the audience?
Perhaps, David, just what you were saying earlier and indicating in terms of kind of this overall transition from establishing what is best practice for setting ambition, i.e. the target itself and kind of that future looking target and state, to integrating more of this aspect of performance, right? So we do have, you can see kind of towards the bottom of this screen that we really are developing a framework for how companies perform against targets and how we can kind of integrate some element of accountability into the standard itself. And then also, that enables companies to make claims. So companies that are doing good work, how can they claim that good work they're doing? So if you are increasing your portfolio of low carbon steel, low carbon cement, how do you express that to the market in a credible way and have kind of the SBTi standard there to back up those claims? So I think these are all really exciting developments, and we're hoping that it just kind of unlocks some more incentives for companies to really take on this work and align to that science-based trajectory towards net zero.
Thank you, Kyra. Yeah, I think a common theme here is just a more pragmatic approach to net zero. And in our experience, we've had clients in the past who have been asked by either investors or customers to set a science-based target, but then when doing the math, it proved to be pretty difficult. So hopefully with version 2, there's additional flexibilities that enable certain sectors to be more comfortable with setting these targets and then making that starting that journey towards net zero. In the next slide, we will dive into this agenda with 4 key changes that we believe are most relevant to the industrial sector. We'll dive into the increasing way of setting a Scope 1 target within the proposed changes, the expansion of market-based accounting beyond Scope 2 to Scope 1 and 3, the ability to take responsibility for your ongoing emissions, and the changes in the carbon removal guidance to help create near-term demand for carbon removals. There's one glaring omission in this, which we've omitted on purpose, which is Scope 2. We can spend a whole hour just talking about Scope 2 and the clean energy requirements and standards, and it's on purpose that we're not touching on it, and we're happy to follow up on that if you all want. But we believe in the hard-to-abate industry, these key changes are pretty material to helping manage the risk, build institutional buy-in to set a target and feel comfortable that the risk and opportunity associated with setting and achieving net zero can be articulated to key stakeholders. All right, so on to the next slide. So one of the first key changes is this new target options that companies will have during the process of setting a commitment to the SBTi. Traditionally, on scope one, you used to have an emissions metric target, which was usually based on a linear contraction or sectoral decarbonization approach. But that blanket approach to setting emissions made it very hard to articulate the nuance of decarbonization for certain industries. For example, there are certain companies who the majority of their power generation comes from clean energy. So in that sense, the marginal abatement required became very, very difficult to do. So perhaps in that situation, the new alignment-based target might be of interest to them, which is I'm committing to increasing the share of low carbon activities such as generation of clean energy or clean fuels that then are aligned to the decarbonization threshold required by the SBTi. Another example are firms that have very high capital intensive requirements and that have specific replacement cycles. So you can think about this such as airplanes or certain manufacturing facilities where the linear approach just does not apply. It comes across more as a step change. So this is another alternative target setting pathway for scope one, where the SBTi is attempting to articulate and provide more flexibility for some of the nuances of decarbonization trajectories that are simply just not linear. Kyra, is there some context that is worth sharing with the audience on why these two new pathways? And I don't know if you're allowed to share, but is there any updates relative to the wrap up of the second consultation related to this pathway?
Thanks. I think so. In terms of the context and the why, I think it's exactly what you said. We realized that for some industries, some companies, it just, constraining the decarbonization approach to kind of these discrete 5-year cycles. And that's traditionally how kind of the SBTi has been structured, right? It's a linear pathway that goes from the target year and progressively is supposed to decrease over year, right? Until you kind of meet that 5-year or 10-year target cycle. But what we realized, what we heard is, wait, that doesn't align to our capital planning process. That doesn't align to how we actually kind of do business or what that overall timeline looks like. So that's really, and specifically for this asset decarbonization plan, is just trying to align better to the overall business planning practice and timelines that may already exist for a company while providing guidance around that overall carbon budget. So we're essentially saying, you can maintain your overall planning timelines. You can be planning to replace a majority of assets in 8 years. As long as that meets this overall carbon budget and you're staying within that, you can still be on track to meet your science-based target, right? So it's just kind of trying to align pragmatism. I think it's a great word here. That's what we're trying to do in a lot of different areas in this standard, while maintaining our scientific integrity, right? And that's where that carbon budget comes in. For the alignment-based targets, historically, we've learned that a lot of like climate solutions providers and these companies that we actually want to see grow in the near term, they haven't been able to take advantage of science-based targets because of that linear approach. So that's really this alignment-based target setting is really trying to enable those companies that we want to see more low carbon fuels. We want to see more low carbon steel. We want to see these types of things kind of increase their overall market share, right? Because that's leading to a greater overall emission reductions across the market. So these two things, we're trying to kind of address those gaps and again, make it more pragmatic for more companies joining and getting on that path to net zero.
Yeah, exactly. That's an incredible, useful summary. And we're all very hopeful that this really is finalized and included in the final version that is to be published this year. Kayla, I would love to hear more about your experience advising companies and how, this currently proposed change has been reflected in some of the experiences that we've had with one of our clients.
Yeah, of course. Thanks, David. So as we just heard under SBTi, there is a strong emphasis on demonstrating a credible pathway to emission reductions, but now there is more proposed flexibility in how companies can actually set and achieve those targets. So we wanted to walk through an example of how one of our partners has addressed target setting in the past. We've worked with a global manufacturing company to actually evaluate multiple decarbonization options using an abatement cost curve. We then translated this to an absolute greenhouse gas reduction target. So really having this asset level decarbonization plan speaks to how leading companies have completed abatement cost curves in the past to reach their target. And this reflects the type of risk management that companies have historically had to undertake. So the corporate net zero standard 2.0 really supports a more flexible company-specific pathways while still holding firms accountable for that credible delivery and risk management. David, I'll pass it back to you to see if you have anything to expand on there.
No, thank you, Kelly. You covered it very well. And I think fundamentally is the SBTi with these proposed changes is speaking more a business language. So oftentimes at ClimeCo, we've had to develop these abatement cost curves to articulate the cost to achieve a target. And now with these asset decarbonization plans, as well as alignment targets, this helps reduce internal barriers as we were trying to build executive buy-in to establish a target and move forward on a company's decarbonization plan. Thanks for that, Kayla. All right, so on to the next one. A key thing ClimeCo is very excited about, and that's been a long-term coming, is the unlocking of additional decarbonization impact through market-based accounting. Many of you probably know in the audience that market-based accounting is driven by another standard called the Greenhouse Gas Protocol Initiative that allows it for Scope 2 emissions. That is usually purchasing what we call renewable energy credits and booking claiming them on a different ledger, which is called a market-based accounting ledger. So one of the big exciting changes SBTi is proposing is expanding it to Scope 1 and Scope 2 and Scope 3 and articulating kind of some nuances to make sure the industry understands different roles of what a general term are environmental attribute certificates. The renewable energy credit that I just described, it would fall under that left-hand side on all of your screens as an energy carrier. But Kyra, I would love for you to explain a bit more how the SBTi has been thinking about this, and the why this has been something that has already reached the second public consultation period.
Absolutely. So I think as we think through, again, focusing on the overall goal that we all have, right, which is to reduce emissions as quickly as possible, as widespread as possible, so that we do, hopefully reach net zero by 2050 and limit the worst and most catastrophic effects of climate change, right? And we realize that in some cases, the reliance on physical traceability, physical delivery is not always the most low carbon or low emissions way to conduct decarbonization, right? So in the kind of classic example of something like requiring physical deliverability of staff, does that make sense, right? Trying to transport a fuel across the country so that you're meeting this kind of physical deliverability aspect doesn't totally make sense when you kind of do the math on the overall emissions impact. So there's a recognition here that, I think there's this tension between the integrity piece, right? We want that integrity to be there in terms of driving real impact, ensuring that any kind of credit or certificate in use is credible. And there's this recognition that sometimes market players are constrained, right? Whether that's from traceability, geographic location, market location, regulatory barriers. There can be a lot of barriers in place to actually procuring some of these items. And so that's kind of where the market-based accounting comes in, where some of the certificates, where some of the credits come in, is allowing companies to invest in these activities even if they are not able to directly trace them into their supply chain or directly kind of make that direct intervention or investment.
Yeah, thank you, Kara. And I think the history and story that we've witnessed with renewable energy is something that we might start witnessing with agricultural commodities, industrial commodities. I think the audience might be most interested in industrial commodities, just steel, cement, and aluminum, to name a few. At the end of this presentation, we will touch on the concept of an environmental attribute credit strategy, because one of the things that we've worked with clients as this rapidly shifting landscape has been changing is that there's nuance and different roles, and they're all part of a toolbox. Carbon sequestration credits play a role, carbon reduction credits play a role, carbon removal credits play a role, as well as these commodity certificates. And it's pretty critical to understand how each of these interplay with each other, especially when version 2 becomes officially published. But Kayla, I know you've worked on navigating this nuance with a handful of companies. So what's been your experience with this?
Yeah, absolutely. So this is certainly one of the changes that I'm really excited about, and we're already seeing these EAC models applied in real world settings across multiple different sectors, cement, steel, fertilizer, aviation, and others. I think one key example that helps to illustrate the importance here is ClimeCo's work with a hyperscaler and one of our global building materials partners. The hyperscaler has a full net zero target, but they don't quite have access to the low carbon materials that they need. And that's due to some of those challenges that Kyra just discussed. And so to address those, they're leveraging EACs as a credible pathway to reduce their scope 3. And this approach, not only helps the hyperscaler to meet their goals, but it also creates a new, demand-driven revenue stream for that building materials producer, which in turn helps them to pass hurdle rates and ultimately bring new low carbon products to market. The key thing being is that these products would not come to market without that extra revenue from the EACs. So strategically, it really helps to accelerate the lower cost of scaling low carbon technologies while maintaining alignment with standards like SBTi.
Thanks, Kayla. And I think a very critical thing to consider is this has been happening before version 2 guidance has been finalizing. So our hope is with version 2 guidance getting finalized, the pool of buyers is going to go beyond, let's say, these first movers such as hyperscalers to just all participants in the SBTi ecosystem. So that's something important to say. And then another thing, Kayla, that I'd love to hear a bit more about is how are companies navigating traditional expectations of selling a physical product versus, selling it in a way, let's call it not non-physically. And what are the sort of things that we do to kind of build those programs to get to a shared end game?
Mm-hmm. Yeah, it's a great question, David. And selling these attributes is different than selling the physical product, right? There's different language. The buyers are coming from a totally different angle. They're asking questions about additionality and leakage, these kind of carbon market terms that are not typical in physical procurement offtakes. And so how ClimeCo supports there is really helping our partners bridge the gap between these different language, almost being the translator, leveraging our experience in carbon markets and some of these emerging standards like SBTi. There's also the AIM platform that are setting the rules on how we can do this credibly. So we are ensuring that everything is done in line with standards to make sure that both companies are able to meet their targets. Because at the end of the day, an EAC allows the buyer to reach scope 3, but it also allows that seller to get that scope 1 reduction. So it's really critical that everything is done in line with standards.
Exactly. Yeah. And standards means risk management. And the AIM platform is also going to finalize their standards in the first half of this year. So we believe that between SBTi and AIM platform, we're really excited for kind of this growth and for much needed guidance and clarity for the market. All right. So then going on to the next slide. Another very exciting change is the ability now to take responsibility for ongoing emissions. Historically, before version 2 was announced, this was framed as beyond value chain mitigation by the SBTi. And now this has been adjusted a bit to pretty much be designed into a recognition program, which As it stands right now, which it might change, you have a leadership level and a recognized level. And it's designed to just reward and articulate companies who are going above and beyond their internal decarbonization to respond to decarbonization opportunities outside of their value chain. So this includes ex post mitigation, which includes carbon credits. It can include investments in R&D as well as in policy advocacy. And a key change is on the leadership level is the amount of coverage that a company would have to include, as well as the driving carbon pricing. But Kyra, I know this was a very contentious process to get to this current proposed change. So I'd love to hear more about how did the SBTi get to this proposed solution, and is there anything that we should all be aware of as these final deliberations are going on?
Sure. So if you have been following along with this entire process of developing version 2 of the corporate net zero standard, you may have seen in the first public consultation in the earlier version of this draft, as David said, we really had divided out beyond value chain mitigation and taking responsibility for residual emissions. So those are the emissions that we anticipate a company would still emit after they've reached their net zero target year. However, we know there's also these emissions that will continue to be released as a company is on that trajectory to net zero. So what we've done in this framework is kind of, to some extent, combined that entire emissions portfolio into what just overall is ongoing emissions. And there's a couple different ways that companies can take responsibility for these. So what we want to do here is develop a credible pathway for companies to claim their leadership in these areas. So here, this is the proposal that we've started with. You can see the recognized level starts at 1% or more of ongoing emissions, which in leadership is 100%. I can tell you now that we've gotten a lot of feedback on this proposal specifically. So without, I myself have no idea where these things will end up. Disclaimer there. But I do know that this is one area where a lot of folks had feedback, a lot of folks had suggestions. So I just would anticipate that we will see some changes to this overall area while still maintaining the intention of providing some sort of credible framework for companies that do want to go above and beyond their net zero target.
Thank you, Kyra. And I think it aligns again to this general theme of pragmatism. I think historically there's always been a bit of a either or when it came to kind of beyond value chain mitigation and internal decarbonization, and it's not constructive. I think it's an and situation, and one of the things with our clients that we continue to help them navigate is this audience, in all honesty, has perhaps more difficulties to hit net zero than others. And I think the ability to have access to this helps reduce the risk, helps with socializing, getting executive buy-in. And it's something that is definitely pragmatic for these leaders who have attempted to set science-based targets in the past and now have an additional tool in their toolkit that helps manage that risk, which is can be higher for some of us in the audience. Kayla, off to you again. So what examples have we engaged with as it relates to this situation?
Yeah, so with this change to recognize offsets, we're also seeing that increased ability for more companies to participate in SBTi, just like you were hinting at, David. So I'll walk through a specific example. ClimeCo actually worked with a chemical producer to help clarify, the differences between carbon neutral and net zero pathways. And as you were just mentioning, and I think this group knows very well, achieving net zero can be financially challenging, especially for hard to abate sectors. So to still, show that climate action, we helped them to procure carbon offsets. And a part of that was a diligence process and helping them with cost analysis to make sure that the credits they were pursuing matched with their goals and were high integrity. And now, this is an exciting proposition as this will now align with the SBTi recognized status, which provides that credible backstop by allowing the use of verified offsets for ongoing missions. So really, all in all, this makes SBTi a more realistic and accessible option for companies that might not otherwise be able to commit.
Exactly, Kayla. And there's some two very important nuances I'd like the audience to understand. Number one is, I think one of the pathways to ensure this is has integrity is the carbon price that's involved. Having a process to establish like what is the budget that a company is comfortable with, and that's something that the SBTi will give additional guidance on. There's different carbon prices that were proposed, and that ends up determining how much funding a company might be comfortable in investing outside of a company's operations. And number two is it's not mutually exclusive with internal decarbonization, but in this current situation, carbon capture and storage was a very important lever, but deploying CCS made a lot more sense in all the adjacent sectors where just the project costs were more reasonable due to things such as flue gas concentration and access to storage facilities. So there were some like structural limitations that just made it unviable for now, which might make it viable in the future. And I think this recognition program just enables that financing continues to happen to other areas of the world, and that we continue to fight the climate change. All right, then. So,
David, can I maybe jump in just to
yes,
clarify one
please.
other item on that slide, just to make sure that it's abundantly clear that the recognition program and utilizing things such as offsets or investing in research and development, contributing to low carbon markets, these are things that are above and beyond the science-based target, right? So companies can only take credit or claim the recognition piece if they are on track and meeting the goals of their science-based target, which is kind of that more internal and supply chain decarbonization piece. So it is not in lieu of, it is not, but it is in addition to. So, and the other note on that is that different industries have different projected residual emissions. So we know that some industries will have greater residual emissions at the net zero year and beyond, particularly industrial industries, harder to abate industries. So it isn't that all industries are aiming towards the exact same kind of end goal at that net zero target year. We know that depending on the business, those residual emissions will look different.
Thank you for clarifying. And indeed, the priority is the internal decarbonization, and I think we're excited to review the final version because I would assume that all of this final guidance on how this should be used, what are the priorities, how do you continue to evaluate performance within the target cycle process, would articulate kind of how this should or should not be used. So thank you for that, Kyra. All right, so then onto the next key takeaway is one of the challenges that we had in version 1 is the carbon removals were already articulated as part of the journey to net zero to address residual emissions, as Kyra had described. However, that was a requirement that was articulated to hit net zero emissions, which depending on the sector would be 2040 or 2050. But in order to get to that point, you have to scale a market that is still in its infancy. So one of the key critical changes is SBTi has offered additional triggers and requirements to help generate near-term demand for carbon removals to grow the market so that the market can actually respond to the amount of removal opportunities that is requested for a societal-wide carbon removal. So Kyra, do you want to elaborate a bit more on kind of the journey with this? We think it's incredibly constructive because as at ClimeCo, we develop carbon removal projects, and they take a lot of time and financing and diligence to make sure that they're high quality and enable companies to claim what they want to claim.
Sure. So we recognize that so essentially, kind of the thought process behind trying to incentivize and enable some near-term demand for carbon removals is the recognition that if all of these companies, which David mentioned earlier, we now have 10,000 companies that are validated with the SBTi. If all 10,000 of those companies are aiming towards net zero and all of the sudden get to 2050, and then go, oh, wait, we need all these removals to neutralize, the infrastructure in the market won't be there to meet that demand, right? And so it is this process of needing to create. So the balance and the tension here is having companies invest enough right now that they're actually starting to create some of those market signals and starting to build that demand, while not making it overly burdensome, especially for companies that perhaps don't have the same resourcing as other companies. So as you can see here, the proposal that we put out in the second public consultation is that in 2035, which also I'll note here that we also had a question about, could we do this in 2030? But that was in the consultation as well. Is that category A companies, so these are companies that are larger, based in higher income regions, would actually be required to start procuring removals as they go forward to their net zero target year. So we think that hopefully creates some equity in terms of what companies are responsible for really starting to drive this market, but hopefully doesn't introduce something that is so burdensome that companies, can't continue on in their science-based target setting journey.
Yeah, from our experience being in this for more than 10 years, it's extremely productive to go from this is what it means to hit net zero aligned to the Paris Agreement to then, okay, what the influential role SBTi has to create demand signals, catalyze markets like that is a really important role. And this is a prime example of what we think will enable companies, especially perhaps in industrial decarbonization, to feel a bit more comfortable with their journey because they might have higher residual emissions than in other sectors. And we're not going to dive deep into what Kyra described about category A or category B companies, but that is also one of the changes in version 2 to help with equity as well as to continue to increase participation in the initiative. But Kayla, I know you've worked on some deals and removals as well, so I'd love to hear more about our experience there.
Yeah, of course. So, as we just heard, removals are an aspect of our credible net zero pathway, and companies are certainly starting to pay more attention here. So we are seeing leading companies already taking this approach as they do work towards their targets. I think one key example is one of our partners who's a multinational consumer packaged goods company. We're actually helping this firm to act early and procure removals now. And this allows them to secure competitive prices ahead of those final standards. And to Kyra's point, it also provides a market signal, which then increases the overall demand for removals as companies do get closer to those longer term targets. They recognize that sourcing price competitive removals, it's still challenging today, but it is expected to become more difficult as this demand increases and as companies do get closer to those end dates. So really what this company is doing reflects this proactive strategy to help them manage costs and supply risk while staying aligned with those evolving SBTi expectations and showing climate progress.
Thanks, Kayla. Yeah, I think that the accessibility of high quality carbon removals is an expected challenge from this partner. And then the ability to develop the projects in a cost competitive way and grow the volume of removals is definitely a challenge too. At ClimeCo, our main priority is nature-based solutions, but we definitely have peers that focus on engineered removals as well, such as direct air capture. All right, well, with 15 minutes, I'm excited to kind of touch on one of the key. There's two key themes in this agenda. We talked about the pragmatism of the changes that SBTi and Kyra and the team have been proposing for version 2. But another one is, as it relates to that pragmatism, is the role of market-based solutions to help accelerate decarbonization, provide flexibility, but also still ensure integrity when it comes on to the fight against climate change and the alignment with the Paris Agreement. So we've touched on the concept of carbon removals, carbon insets as well, and other EACs, as well as carbon offsets. So what we'll touch on now is pretty much how do all those three interplay with each other? And with the finalization of version 2 of the guidance, how must the company think about each of those in a holistic manner? And that's how we've worked on with other peers as it relates to developing EAC strategies. So in the next slide, this is a very simplified graphical representation of the journey to net zero emissions. Originally from the SBTi, we have the interim science-based targets that target to achieve net zero emissions, and then that optional compensation. But what you see here now is overlaying the changes of version 2. So the expansion of market-based solutions enables companies to come with a more cost-effective strategy to achieve their decarbonization objectives. But in order to do that, they have to have a strong understanding, first of all, of their abatement cost curve. So that is an analysis that you do for the interventions that most likely you're going to own and deploy within your operations. Oftentimes, in the majority of the sectors, there's going to be a portion of that cost curve that has what we call breakthrough technologies that are currently commercially expensive, but are expected to go down the cost curve in due course, such as carbon capture and storage. Now, assuming the proposed changes are finalized by the SBTi, there's now the role of what we call carbon insets, which touch on interventions within your value chain that can help reduce emissions through certain decarbonization technologies that aren't physically connected to your operations. But like Kayla described, the integrity is still incredibly high because of it's aligned to key standards that are under development. Following with that, you have carbon removals, which the current requirement is a 2050 requirement that might be forwarded to 2035, but they play a very critical role on addressing the residual emissions like Kyra described. And last but not least, you have the carbon offsets, which is the ability to kind of demonstrate environmental leadership on that journey to net zero through the new recognition program. But all these three sort of environmental credits, as we described, have a cost component and a risk component, but they relate heavily to a company's abatement cost curve. So on to the next slide. A company with the finalization of version 2 of the guidance should have a strong understanding of what a portfolio approach would mean to a combination of these three credits, with the end game being net zero emissions, where the majority of your investments are going either into physical internal decarbonization or non-physical decarbonization through market-based solutions. The reason offsets in this graph are perhaps higher than with other audiences is because of the nature of hard to abate sectors. But again, I want to just double down on what Kyra said. It's above and beyond to what the SBTi said. And what's critical, therefore, is depending on the carbon budget the company has, is how comfortable they are allocating money to internal decarbonization or to market-based solutions, and how can these new market-based solutions perhaps hedge risk and improve the economics of the journey to net zero. All right, so we have one final case study. Kayla, if you want to kind of introduce it before we go into Q&A.
Yeah, thanks, David. So we are helping companies to put together these EAC strategies and really do it in a way that diversifies their portfolio to reduce their risk. And so making sure that our partners have, EACs across everything that David just went over, the insets, carbon credits, and removals. This helps them to really make sure that they have this diverse portfolio to make sure that they can, spread out the cost and hit these targets in a way that best aligns with where the market is going in terms of supply and delivery.
Thank you. And Kyra, do you have any thoughts on this? Because one of the things we've experienced is traditionally these credits were thought about in silos, but companies usually have one budget for their decarbonization efforts. So knowing how they interplay is pretty valuable to our partners. But before we get into Q&A, I'd like to open the door with you if you have any other thoughts on this.
No, I think you all really covered this. And I think one of the kind of advantages of being a first mover in this space or someone who is more on the leading edge is to lock in some of that preferred pricing. We've just seen that really come through when we kind of are talking to companies about how they may start really implementing some of these things and operationalizing, particularly in regards to their EAC strategy. But I agree. I think it makes sense to look at these things more holistically. And I think that's hopefully what we're trying to do in a lot of the aspects of this version two, is looking at the business, the operations, supply chain, et cetera, more holistically, and giving a lot more levers for companies to pull as they go through their overall decarbonization journey.
Exactly. And I think a lot of the challenges we've had is articulating the cost as it comes to that journey to net zero. But I want to be very clear that there's a lot of value to be generated from this because, again, under the assumption these propositions are finalized, we're creating very strong market signals that enable companies who have an ability to start manufacturing, let's say, low carbon cement, low carbon steel, to have more buyers for this. And then in the long term, that should really translate into product lines that are perhaps premium, but there will be buyers for it thanks to the SBTi. All right, well, with 8 minutes, I'd love to open the floor to a Q&A. Again, we're really, really grateful for Kyra for making the time. So, Kayla, is there any questions for us?
Yes, we have lots of questions. We probably won't have time to get to them all, but we can certainly follow up after if we don't get to your question. The first one, Kyra, it's for you. Are all changes aligned with the greenhouse gas protocol for corporate reporting from a corporate reporting perspective?
So this is a question we've been getting a lot because greenhouse gas protocol is in the process of updating some of their major standards at the same time that the SBTi is embarking on this journey to update our, most major standard. So what I can say is that in general, greenhouse gas protocol establishes the best practice in accounting, right? So the inventory accounting process. The SBTi directs companies to account for their emissions aligned with greenhouse gas protocol. In some situations, the SBTi may need to make decisions prior to greenhouse gas protocol or that are slightly different, but overall, we are striving to stay aligned. We have folks on their working groups, they have folks on our working groups. So the intention is to overall stay aligned to ensure that the market has the most clarity and harmony as possible. But it is, we are independent entities. We are updating these at different paces and at different rates. And so in some situations, SBTi may have to make a call before some of those standards are finalized at greenhouse gas protocol.
Great. Thanks, Kyra. And actually, a follow-up kind of related question, and maybe Kyra, you can start with this, and David, it'd be great if you could expand with maybe an example of how we're seeing this with our partners. Can you please re-clarify if SBTi would allow corporations in hard-to-abate sectors to use market-based solutions using a suitable book and claim methodology to meet their near-term Scope 3 targets, or is it over and above?
No, so market-based mechanisms are, as it's been proposed, would be allowable in mitigating Scope 3 emissions. What the distinction and differentiation for whether something contributes to your science-based target or qualifies in that over and beyond is really that difference in the relation to your overall value chain and the integrity. So something that's thought of as a traditional carbon offset, i.e. has no correlation or through line to your value chain or operations, that sits squarely in that above and beyond. Something, and we go into a lot more detail on how to define what is some level of continuity and or relation to your value chain and operations in the standard, but things that are a market-based mechanism that are addressing things that are really part and parcel of your overall operations and value chain, those are permitted under this standard.
Yeah, I agree with Kyra. I think some of the feedback we gave to the SBTi was we're very excited about market-based mechanism for Scope 3. Perhaps it was a bit too constrained in our opinion, so we will see what the final version is. However, what we've had experiences at ClimeCo is for companies who've already made interventions in their supply chain that but they have been unclear about the actual tonnage of CO2 equivalent that translates to. We've been brought in to kind of figure that out. So that's kind of like a post-intervention support system. And part of that exercise has been applying this standard that Kayla has described called the AIM platform, which it's by design, it's designed to help prove that the money is going within your value chain, within your scope 3. And there's key criteria to make sure that you hit, and there's an absolute floor. Like if you do not hit that floor, you would not be able to claim this as a value chain intervention, and it could be claimed as a beyond the value chain, but not an intervention. So that's one example. And then on another example is at ClimeCo, we've transacted in value chain intervention credits or insets, where we have already done the work of proving that it is within the value chain, the same way we're traditionally speaking carbon offsets have had registries to prove their additionality. We've already applied the AIM platform and other standards to say, hey, like this is a true value chain intervention, and who we've transacted with have been leaders just because those who are perhaps a bit behind or risk averse have just been waiting for the SBTi's guidance to be finalized.
That's great. Thank you. This next question hits on EAC demand. So David, maybe we'll start with you, and Kyra, please feel free to weigh in. Supplier engagement can only go so far, since so many of the largest scope 3 category 1 emissions sit far upstream in commodities like cement, steel, copper, and ammonia. Even as SBTi appears to be moving towards acceptance of EACs, that momentum does not yet seem to be translating into increased demand. What will it take for EACs to go mainstream as a credible corporate climate tool? And when do you expect the market to meaningfully scale?
Oh, those are big questions. Well, I guess, Kyra, on our end, we think this year is a pretty critical year with SBTi and AIM platform getting finalized. That's one. We're still, in all honesty, at haphazard until the Greenhouse Gas Protocol finalizes their guidance. So in that sense, the speed of just the market growing will still be slower in my eyes than what it could be. But that I think is necessary because it's a really difficult job that our peers have, and to do this intentionally well and with integrity. And when it comes to continue to generate demand, what ClimeCo has been doing is be a peer for managing that risk. So the transactions we've done have been arguably higher risk because version 2 hasn't been finalized, but we've aligned our advice to what we've been seeing, to what other peers are doing. And that risk is just by default lowering because these guidances are going down. And for those interested, ClimeCo is having an Insetting workshop at GreenBiz in 3 weeks, I believe, for buyers. So we're aggregating demand for this limited volume of credits that currently exist to kind of share lessons learned. But alternatively, we also have done bilateral deals, whether it's purely between companies that we've helped set targets historically and companies where we've helped develop those decarbonization efforts. So a lot of moving parts. We think that the direction of the journey is correct, and this year is pretty critical. And I guess there's a call to action to please feel confident to at least start piloting transactions. But Kyra, what do you think?
I think that's exactly right. We know that there are a lot of stakeholders who are really waiting for that guidance to be finalized, right? We know there's a bit of paralysis in the market right now as folks are waiting for SBTi to finalize guidance, for Greenhouse Gas Protocol, for the AIM platform, et cetera. And I think what I would say is I have a hard time imagining us really kind of coming back and or reversing some of these things that we've already put out. So, while things may get ironed out, there may be additional integrity criteria that are eventually mapped, et cetera. I think particularly some of these organizations that have been working in this space for a while are likely aware of what some of the best practices are in terms of integrity. And then I think just from a very, high level scientific approach, we know that all action is needed as immediately as possible, right? And so there's no, in the case that maybe something doesn't qualify as in value chain, or maybe it does have to be counted as beyond value chain, there's still that service to society in the greater market, right? It's not like you're doing something harmful by doing these things, right? So, we know that everything is needed right now, and I think that, hopefully, like, we're encouraging companies to, as much as they can, go ahead and, drive forward with every tool in their toolbox. And, we kind of, the accounting piece, the claims, the all of that, we're hoping to still iron out and keep us somewhat aligned to the draft.
Yeah, really great answers. Thank you both. And unfortunately, we are up at time here, so we won't be able to go through the remaining questions, although we're happy to follow up via email. And please do feel free to reach out to either the ClimeCo team and Kyra. I'm assuming you're open to reach out as well. With that, David, any final comments closing before we wrap up here?
Thank you to the audience. It's hard work to decarbonize the industrial sector, so thank you for the continued work. Thank you to Kyra for making time in her busy schedule to share the updates. Thank you to the Decarb Connect team. And I guess to wrap up, Kyra, timeline, is there any updates that you can share with all of us to close off on when to expect the version 2, or is that still a moving target?
What I can say is that we know kind of the sense of urgency here. And so we've said mid to late 2026 is really kind of our overall target. I will say very excitingly that we have seen some progress, I think, move a lot quicker in the past, just from an internal perspective. We have a lot of people working on this, so we are really hoping to kind of stick to a crisper timeline than perhaps has been done in the past. So yeah, just keep an eye out. And of course, when we do have more clarity on potential timelines, we'll be making sure to kind of put that out to the market and our stakeholders.
Thank you so much.
Thanks all.
Hey, thank you, everybody, and thank you to our wonderful speakers here today for the insightful presentation. Just a quick bit of housekeeping. We'll be sharing a recording of this webinar with you all in the next week or so, so do keep an eye out for that. Please do email me at jack@decarbconnect.com if you have any questions about this presentation, or if you're interested in hosting your own. ClimeCo will be joining us at our upcoming event in Houston, February 10th and 11th. So do book in now if you'd like to continue the discussion, and also to meet our wider community there. But if not, we'll see you at our next webinar. Hope everyone has a wonderful day, and thank you once again.